Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 152, Market Outlook 2021. Thank you all for joining me back on another episode of Upticks. I hope everyone out there is staying safe and healthy during this horrible pandemic. For today's topic, as we've finished the first half of 2021, I wanted to take a time out here and give you a market outlook onto where we think things are headed. And if you're a client of Falcon Wealth Advisors, I'm really excited because we're going to be emailing out a trade summary. So of all of the macro trades that we've done for 2021, along with a complete rundown of all of your individual stock holdings as far as the big portfolio that we manage. If you have some one-offs, they won't be in there. And then we take a deep dive into our market outlook with Brandon Reed, who's a chartered financial analyst on our team. He wrote a really nice summary of everything that's going on out there. So if you're a client of Falcon Wealth Advisors, and again, unfortunately, that's for clients only, maybe fortunate for clients, we are going to be emailing that out. It may already be in your inbox by the time that you've received or watching this video or listening to this podcast. But for today's topic, I really wanted to talk about two very important points here regarding market outlooks in general, and particularly with 2021. It's probably one of the most common questions that I get in reviews. Jake, where's the market's headed? Or what do you guys think is going to happen? What do you guys think is going to happen the next 2021, 6 months? Or in 2022 or so forth. So what is your market outlook? And the reality is, and I think people understand this, but they still want to ask the question, is that nobody truly knows. And if we're looking at the data, as of the recording of this episode, the S&P 500, which is the 500 largest companies in America that are publicly traded, is up over 15% through the first half of the year here. Last year, it was up over 15%, and the year before that, it was up over 25%. So we've been on a phenomenal run here the last 2.5 years, and people are starting to get nervous, which is probably normal, and asking, when is this party going to end? At some point, we have to get to mean reversion, and it has to pull back. And so the first point I wanted to make, not only does anybody not know when the market pullback is going to happen, you're certainly not going to know by listening to the news. Now, I love the news, and I listen to CNBC every single morning while I get ready. We have it on in our office. I'm reading things throughout the day, looking on my phone, checking in. I get it. The reality, though, is CNBC does not know when the next market pullback will happen. It did not predict the market crash when COVID broke out. It did not predict 2018, the last time we had a negative year. And it certainly didn't pick out 2008 when we had the Great Recession and the market pulled back over 50%. In fact, nobody did. Maybe you have some very few people after the fact, or maybe there were some very eccentric people calling for doom and gloom. And I got a quick point on that here in a moment. But just because you hear something on the television or read about it in the newspaper does not necessarily mean it's going to play out. I'll tell you exactly what causes market crashes. And what causes market crashes are the unknown unknowns. I know maybe it's disappointing that nobody can predict it, but you should know that by now as an investor, that if somebody could truly predict the market, either one, they may be trading on insider information, and that is illegal. Or two, they're always predicting doom and gloom, and they're doing it to get eyes on their content or listeners to their audio so that they can sell books or whatever. They're just doing it to monetize it. And if they always predict that pullback's going to happen, eventually one will happen, and then everyone will think they're brilliant. They'll make a lot of money, and then they'll go back to predicting doom and gloom, and they'll get it wrong many years or many times over before they get it right again. So it's important to remember that the unknown unknowns are what caused the market crashes. We did not know the pandemic was going to sweep the globe and be as severe as it was. We didn't, right? And the market crashed 30% in 1 month, which is crazy in its own right that it's come back so quickly. which is awesome. But nobody knew that and nobody could have predicted it. So what can you do to prepare for these inevitable market crashes? I'll tell you that right after I give you a quick commercial break on our content. So thank you again for tuning in. If you're not already a subscriber, we'll put the subscribe button up here in the video. Please feel free to subscribe. That's the best way to make sure you're not going to miss another episode of Upticks. Also, if you're listening to this on your favorite podcast platform and you want to give it a thumbs up, we greatly appreciate that. And feel free to subscribe on there as well. I'm also out there on various social media platforms. That's one of the channels that I do push out our content to. So if we're not connected on Facebook, Twitter, Instagram, or LinkedIn, please feel free to send me a friend request. Also, our company, Falcon Wealth Advisors, is on the same 4 platforms. Okay, so what can you do to protect yourself against the inevitable market pullbacks? That's to have a portfolio that is not dependent upon individual stock performance on a short-term basis to fund your short-term goals. And maybe that's a fancy way of saying don't have too much money in stocks or at-risk assets. So for our clients, what we do, particularly our retired clients, is that we want to make sure that we have at least 5 years, preferably 10 years, not in stocks. And what we buy instead are bonds, cash, municipal bonds, or tax-free bonds, preferred stocks, things that aren't as susceptible to individual stock market risk. Now, there are risks, even if you're in bonds, there's definitely some risk, but the risk is different and the risk is lower. And typically with that piece of the portfolio, you're going to get a much steadier grow or income stream. And that's what helps protect you against the inevitable market pullbacks. And we focus very much on that. So the beauty is, and again, clients wouldn't appreciate this, but if they ask me, Jake, when do you think the market's going to crash? I could technically say, I don't know, and I don't care, or it doesn't matter. And that's a little blunt, but the reality is with our clients, it doesn't matter because we want to make sure that we have their short-term goals covered by short-term investments that are least or less susceptible to market risk, right? And that's a simple part of it. And that's why you hire a fiduciary advisor that's not just pushing products down your throat, that we can, spend the time as chartered retirement planning counselors to make sure that you're properly allocated to fund whatever short-term goals you may have. And in retirement, that's income. Same goes though if you're getting ready to buy a house or a wedding ring or pay off debt or get a new car or go on vacation. You don't want that money in stocks because they can pull back anytime. And if we know that they can pull back when we have the unknown, then we certainly don't want to try to time the market and risk losing money that you're going to need next month or next year or in 3 years, right? And that's why we pick at least 5 years. Now, the second point I wanted to make is that the market, and I've been saying this actually, I believe since 2008, I've been saying this to clients, and I think it's a very powerful viewpoint to understand, is that on average, the market pulls back 10% every 1 year. So literally every year, 20% every 3 years, and 30% every 5 years. So what does that mean? Pullbacks are average or typical, and they happen. Now, the beauty of the stock market is that it goes up far more often than it goes down. So it's called a risk premium. And the idea is in order for you to get growth out of your portfolio and make 5, 6, 7, 8%, whatever that may be, you've got to be willing to stomach the volatility in the short term. And that's a premium that you get to receive by taking the risk of investing in the market. But you have to know going into it that literally once a year, which 10% sounds like a lot, and it is. Once a year, though, it pulls back 10% on average. And we saw a more severe example of that last year. It pulled back 30% last year and still finished up on the year, up over 15%, which is unbelievable and awesome. Right, but that's what you want to be cognizant of, that any money that we have in stocks, and we're managing the stocks directly, which we find a lot of comfort and control and transparency in that, and lower costs in our opinion. But we know those stocks are going to go down, right? And they're going to go up, but they're going to go up. The idea is the plan is for them to go up far more than they go down and more often. So again, once a year, you can expect a 10% pullback. Every 3 years, it may go down 20%. And every 5 years, you can expect a 30% correction out of stocks. and there's no getting around it. Again, you can try to time it, but good luck. It's a fool's game. Nobody can do it consistently. If they could do it, they certainly wouldn't be telling you about it because they wouldn't need to tell anybody. They simply would be doing it for themselves or maybe their small group of friends or whatever. But there's no way that they would be telling you, is my point. There'd be no benefit for them to do that. And in fact, if they told more people, the likelihood that they would be able to time the market correctly, their chances would probably lessen because more people would be influencing market price, and that would be probably hurting their chances of timing the market. So don't get caught up in that. All right, so the big takeaways are, one, the financial media, as much as I love watching them and it's entertaining, they aren't going to be able to predict the next market crash. So just ignore it. It's noise. It's designed to get you to watch their television station more so that they can sell more commercials at higher prices. That's it. That's what they're doing. It's a business, and that's how they're making money. They don't make money if you turn off the television. I always like to relate it to the Weather Channel. I never watch the Weather Channel. The only time I'll probably watch the Weather Channel is if there's a hurricane or a tornado in the Midwest, or flooding or something crazy going on. Well, if they say it's 75 and sunny, the Weather Channel is getting turned off. And so if CNBC or these other major media outlets told you everything's fine in the market, or they didn't know when the next market crash was going to happen, you too would probably turn off that station. All right, and then the second thing is to be prepared and understand that you don't want to have short-term assets in the stock market, and know that it's going to pull back on average 10, 20, or 30%. It just does. It's part of it. It's part of investing, right? So if you want a deeper dive into the actual market outlook in 2021, if you're a client, feel free to open up that market outlook. Brandon did a really good job of taking a deep dive into what's going on as far as the economy. Earnings season is coming up, so we'll be paying close attention to that. We're watching inflation, things out of DC. Hopefully we're putting COVID behind us. All of those things are factors that we're paying attention to and looking at. Like I said, Brandon did a really good job of taking a deep dive into that in written format. That's all the time that I do have for you today, but I do want to give you a quick update on Chicago. I know I shared some pictures last time, but I want to give you a quick review on Lou Malnati's. Lou Malnati's is probably one of the most famous deep dish pizza places in Chicago. And for as long as I can remember, I mean, it must be 10 or maybe even 20 years, I feel like I've heard of Lou Malnati's, and I don't remember if I've ever gone there, which is probably bad in its own right, meaning that it wasn't that memorable if I did. But we went on this trip to Chicago, and it was good, but it wasn't that good. And so I don't recommend it. Rachel and I were disappointed. We thought that it was going to be this wonderful culinary pizza experience, and I didn't want to offend anybody while I was in Chicago, so I wasn't saying too much about it. But frankly, I think I prefer New York style pizza, the much thinner crust that you can fold over and eat. The deep dish just made it feel so heavy, and maybe it's because it's summer. Maybe if I ate it in the winter, it would feel differently. But it was so thick. I mean, I felt like I was eating a pumpkin pie, and it just didn't do it for me. Didn't do it for me at all. So we did try, though, their vegetarian pizza, which was better than the normal, the more normal Chicago deep dish, their standard deal. So if you are going to Lou Malnati's, or you do want to try it anyways, I do recommend their vegetarian over their more traditional. It tasted a little bit better, but again, I don't know if I'll if I would want to eat it again. Like if I had a option between that or something else, I'd probably pick something else. But anyways, just my 2 cents. So, but Chicago's an awesome city for clients that are from there or live there. It's so much to do. It's great to see the city opening back up. We did the river cruise, went to the aquarium, did a lot of walking. So it was a lot of fun. It was just, more importantly, it was good to be around Rachel's friends and make new ones. So anyhow, like I started off the show, hope all of you out there are staying safe and healthy. Thank you so much for tuning in, and I hope you have a great week.